So we're looking at learning objective 2. This is sort of the 5-step process revisited. I'm going to break it up probably into 3 videos. Do steps 1 and 2 in this one, and then 3, and then maybe 4 and 5. Okay, so all the text is doing here is they're going through each step that we went through before, but adding just a little bit more detail to some of them. Steps 1 and 2, they're not adding that much, but we'll go over them anyway, just because this chapter is a beast. Okay, so step 1, when you're trying to recognize revenue, you have to identify, do you have a contract? So you have to have firmly in mind, do you have a contract? So what's a contract? It's the agreement between 2 or more parties, enforceable rights and obligations, and it can be written, it can be oral, or it can be implied from customary business practice. Okay, so when customary business practice, you go in, you order a donut at Dunkies, they give you a donut, you walk out, well, you pay for them. And so that would, you don't write anything down there, you don't say, oh yes, I have a contract, I would like you to contract for 1 donut. No, you just say, give me a donut, please. Okay, so contract, written, oral, or implied. You can only recognize revenue when there is a valid contract. So you have to know the conditions of a valid contract. It has to have commercial substance. I talked a little about that before. Basically, the cash flows, the expected cash flows have to change as a result of the transaction. You can't just exchange like items. It has to have some commercial substance. Both parties have to have approved the contract. Each party has the rights that are identifiable, and the payment terms are known, and it's probable that the consideration, or whatever is being paid, the payment on it will be collected. And that's an important one, because if it's probable that a customer won't pay, or if it's less than probable that they will pay, you cannot recognize the revenue. Okay, so that's a key one, and that will probably get you on some of the homework. So revenue is not recognized until the performance obligations are substantially performed. And so let's, if we look at an example, just go over here and just look at the example. You've got the company enters into a contract to transfer products to a customer on July 31st. Well, I'm sorry, on March 1st is when they enter into the contract. And they're going to transfer the product on July 31st. So on March 1st, you'll notice there's no journal entry because, yeah, they've entered into a contract, but nobody's done anything yet. No performance obligations have been satisfied. So the first journal entry as a result of this occurs on July 1st when the goods are actually delivered. So some of the performance obligation has been done. So you head to accounts receivable, sales revenue, book your cost of goods sold. And then when they pay, these are just your normal journal entries. But the key point is when they say, oh yes, they entered into a contract, nothing's happened yet, okay? No journal entry. Okay, so that's identifying the contract. And so you need to be aware of the, what is a contract? What are the conditions of a contract that make it valid, okay? Step 2, identify the separate performance obligations. Oh, this, here we go. So this is nothing new here. This is strictly review. The performance obligation, you promise to provide a product or service, and it has to be distinct if it's going to be a separate performance obligation. When you sell something to a customer, there can be 1 or more involved in a contract. So a distinct is when it can be sold separately, not interdependent. If you think of the cup of coffee, you order a coffee with cream, those are interdependent, not 2 separate performance obligations. But coffee and donut, those are 2 separate performance obligations because you can buy each one separately. Okay, and the distinct product or service would be, you sell a product, you sell a warranty, you sell a service agreement, you sell the installation. Those could be 4 separate performance obligations depending on the situation. Okay, So that takes us through step 1 and 2 of sort of a relook at this whole process, and next we will move on to step 3, where there's a lot more detail added.